Hey guys, this is a quick market update for the price of Bitcoin. Still down, crypto down, NASDAQ down, S&P down. So this is a market-wide sell-off and a restructuring of price multiples and risk. This is exactly what the Fed wanted when they came out in December and said, hey, look, we're going to raise rates. We're going to take our stimulus out of the market. I don't necessarily see this as a bad thing. I'm going to show you this chart right here and why that kind of proves it. And also this right here, which is basically telling us that the Fed, when it raises rates historically, does so when essentially asset prices rise. So what we can see here on the left-hand side is there's only one time in history that the Fed has raised rates and stocks have gone down in value. They usually go up over the period in which they raise rates, an annualized period. We're getting a sell-off now, but we've got a whole other 11 months. January's a bad month, but there are key dates. So let's very quickly get into those dates. The first one is the Fed meeting on the 25th and 26th of this month. This was initially going to be a nothing burger, really. But it's obviously more important now that the stock market is off so much within 24 days of this year. So this is important to see what the Fed do. And if they are ultra hawkish, then obviously that scares the market more. But I don't think they will be. And to be honest, they don't usually discuss too much in this meeting. The reason why I don't think they'll be massively hawkish is because the market has done their job. This is interest rates in the US, the 10-year treasury. You can see from the tail end of last year where rates were very, very low, about 1.4 and lower. Rates have risen now up to a top or a high around 1.9, and now they're coming off again. So rates have risen. The stock market has fallen. There is some worries about genuine growth, and so rates are coming off again. This is a decent sign that the market has priced in all of the rate hikes. So any rate hike talk is not going to move the market from now on. Some of these sell-offs really have been just a re-rating of risk and various other macro, including Ukraine and everything like that in Russia. So the next one is earnings this week. But most of the S&P, or a quarter of the S&P, I think, are going to be giving out their earnings over the next few weeks. So if these are extremely good and the economy is strong, then obviously what is the difference to the Fed in terms of raising rates? Well, if the economy is very strong, then raising rates is good. They need to normalize policy. Rates have been too low and they've been printing too much money. So this would be a good thing. Obviously, the Fed meeting on the 15th and 16th, this is when they have said that they're going to raise rates. Now, if we look at the meeting, what we can see right here is that for January 26th, so that is the next meeting, there is no change to rates, right? So the consensus is that there will be no change to interest rates. We go to the 16th of March, which is when they're expected to raise rates during that FOMC meeting. What we can see is that there will be a change. So we click on, 22nd of March, you can see no change, only 10%, rate hike 89.7%. This is consensus. It's a CME FedWatch tool. Okay, so most people are expecting a rate hike in March and the rate hike to be between 25 and 50 basis points, probably 25 basis points. That is priced in at this point. And if you look at interest rates, that is priced in at this point. So at some point, when multiples start coming down, buyers will eventually come back in. But at the moment, risk is being repriced, so we're getting this sell-off. But you've seen that it's not terrible for the rest of the year, a multi-year bear market, that doesn't have to come from this. They've also said that the balance sheet will run off towards the end of this year. Again, a good sign. They need to normalize. This is healthy. We cannot just keep pumping money into the market, propping up asset prices higher and higher and higher. It's clearly a bubble when doggy coins are worth 25 billion, right? We need to suck that nonsense money out of the market and get back to normality in a proper long-term assets. What I believe they're doing essentially is shocking the market at the front half of the year to make it look good in the second half of the year when, funnily enough, politicians want to get voted back in. It's not often that a politician will essentially, the Fed and politics are supposed to be not correlated anyway, but obviously they are. Not many politicians want the stock market to be going down when they're trying to get re-elected. So we can take that for what it is. This is actually from Alex Mashinsky, who runs Celsius Network. I agree with these three posts. So the recent market reaction is delivering parts of what the Fed was actually looking for. So if the market does the Fed's job, then they don't have to move in a more aggressive way. Okay, so they probably won't, in my opinion. Reduction of risk on and slowdown of inflation due to risk off and less lending. That's exactly what's happening, right? The market's contracting. You're getting a reduction in inflation of asset prices, which will eventually lead through to a reduction in inflation of actual goods prices, which is obviously what the Fed needs because inflation is too high. Let's hope this is enough to get JP, Jerome Powell, to give us more accommodating language Wednesday. He's probably just going to play it very cool because essentially the market's done his job. So he doesn't need to go ultra hawkish. Why would he? The market's done its job. Interest rates have risen and they've done exactly what he wanted them to do. We have options expiry Thursday. So if the markets don't like what Jerome Powell cooks for us, you should expect further downside pressure on Thursday as well. So that's a worrying thing. I do believe that Jerome Powell kind of thinks that the market's done the job for him. So he doesn't need to go extra heavy in any way, this week. That's my opinion. I might be wrong, but I think the market has done his job for him. And, other kind of macro factors are really not leaning into him being way more cautious. Vendors, and then we have this one. Vendors have used to cause inflation. As we migrate to local manufacturing and revisit just-in-time inflation should go down to around 3 to 4%. The Fed will calm down, so expect to see a rebound in the second half of this year. Crypto markets move 2 to 3 times down more than the NASDAQ, but the reverse is true also. So this is a very large risk-off situation right here, and I think this is actually healthy. We can't just keep pumping money in. It's a risk-off reset, and then we go again. And we watch for maybe these key dates right here. So definitely, I would say this one is the main one when they actually start raising rates. And we'll see what they say this week to kind of allay any short-term fears. If you want to know more about this kind of thing, look at the Crypto Investor course in the description. If you want to talk with me, also see my trade alerts and my portfolio on a daily basis. That is all in the Crypto Investor course. Link in the description, like I said. I James with Money ZG. Cheers for watching, and I'll see you in the next one.